On an ordinary Monday morning, millions of Americans wake up expecting nothing more unusual than another routine workday, coffee brewing, commutes underway, businesses unlocking their doors, families quietly mapping out the week's budget, in the back of their minds the way people do without even fully realizing it. Then a national emergency alert lands on every phone in the country at once, informing the public that due to a nationwide financial emergency, every bank in the United States will temporarily close its doors for 7 full days, branches locked, online banking suspended, wire transfers frozen, and ATM withdrawals severely restricted, with officials urging calm even as the news itself begins spreading faster than any single agency can manage the fallout. Meet Ryan and Olivia, a married couple living in Atlanta with their 2 children, Ryan working as an electrician and Olivia managing a local clothing store, both of them living the way the overwhelming majority of Americans now live financially, almost entirely without cash, their paychecks landing automatically by direct deposit, their bills paid on autopilot, their groceries and gas and everyday purchases running through a debit card or a phone tap rather than a physical bill changing hands. That detail is not exaggerated for effect. By 2026, more than 86% of point-of-sale transactions in the United States are cashless, and well over half of American consumers report using little to no cash in a typical week, a dramatic shift from just a few years earlier, meaning a disruption to the banking system today lands on a population that is fundamentally less equipped to fall back on physical currency than any previous generation of Americans ever was. Ryan and Olivia have money saved, real money, sitting in an account that still legally belongs to them, and yet in the opening hours of this shutdown they discover a strange and unsettling truth, that having money and being able to access it are not actually the same thing. Within hours, long lines begin forming outside grocery stores and gas stations as people rush to stock up on food, water, and household essentials before payment systems become any less reliable than they already are. Some retailers still accepting cards while others abruptly shift to cash. Only transactions as electronic payment networks start experiencing delays and processing failures. Gas stations reporting shortages driven not by any actual supply problem, but by the simple psychological reality that anxious people fill their tanks first and ask questions later. This is not a new pattern invented for a work of fiction. It is a near replica of what actually happened across the United States in the final days of February and the first days of March 1933, when a genuine, unstoppable banking panic swept the country, customers withdrawing more than 20% of all deposits held in the entire national financial system within a matter of weeks. Individual states declaring their own bank holidays one after another as the crisis spread from Michigan outward until, by the morning of Franklin Roosevelt's inauguration on March 4th, every single one of the then 48 states had already shut its banks down in some form. Roosevelt, barely 36 hours into his presidency, issued a proclamation at 1 in the morning ordering the suspension of all banking transactions nationwide, an action that shut down roughly 18,000 banks simultaneously and left ordinary Americans, in an era with no credit cards and no digital payment systems whatsoever, scrambling to buy groceries and pay for basic necessities using whatever cash, credit from trusted merchants, or improvised script they could piece together. By the second day of Ryan and Olivia's fictional shutdown, businesses across the country begin facing serious operational strain. Employers cannot process payroll because the banking system underlying every direct deposit and every wire transfer remains completely offline. Small business owners struggle to pay suppliers who, in turn, refuse to ship new inventory without a verified payment. Restaurants have difficulty restocking fresh ingredients. Construction companies delay ongoing projects because electronic payments to contractors and material suppliers simply cannot be completed. Even companies with genuinely healthy balance sheets discover, uncomfortably, that money sitting safely in a bank account is functionally useless the moment the financial plumbing connecting that account to the rest of the economy pauses. Ryan's employer informs the crew that paychecks will be delayed until the banks reopen, while Olivia's clothing supplier refuses to ship new stock because the payment transfer that would normally confirm the order cannot be verified through any functioning channel, and although neither business is remotely close to failing on its own merits, both find themselves trapped by an interruption in the simple flow of money moving from one account to another. Behind the scenes, hospitals, emergency services, and government agencies activate contingency plans meant to keep critical infrastructure running regardless of what is happening in the broader financial system. While at the Federal Reserve, the Treasury Department, and the primary banking regulators, officials work around the clock reassuring the public that deposits remain protected and that the underlying banking system is still fundamentally solvent, because their single greatest challenge in a moment like this is never really the mechanical process of reopening branches. It is maintaining the public's confidence that the system deserves to be trusted in the meantime. This detail mirrors almost exactly the core insight financial historians draw from the actual 1933 crisis, in which the Federal Reserve Bank of New York's own gold reserves had fallen dangerously close to their legal limit, as foreign and domestic holders of dollars rushed to redeem paper currency, driving the very panic that eventually forced Roosevelt's hand. And it was Roosevelt's decision to combine the shutdown with a genuine, credible plan, communicated directly to the public through his first fireside chat on the evening of March 12th, that ultimately turned the tide, with Americans returning more than $1 billion in previously hoarded cash back into bank vaults within a single week, once they believed the reopened institutions were sound, a level of restored confidence so complete that one prominent financial historian has described the episode as having effectively created 100% deposit insurance through psychology alone, even before the formal Federal Deposit Insurance Corporation had been permanently established by law later that same year. By the third day of Ryan and Olivia's shutdown, social media fills with rumors, some claiming banks have simply run out of money entirely, others predicting outright economic collapse, while financial experts spend those same hours patiently explaining over and over a structural reality of modern banking that most people never think about until a crisis forces the question that banks do not physically hold enough cash on hand to cover every customer's deposits if everyone tried to withdraw simultaneously, because modern banking operates on a fractional reserve model, lending out the majority of deposited funds while retaining only a portion as reserves for ordinary daily transactions, a system that functions smoothly under normal conditions precisely because depositors virtually never demand their money all at once, and that becomes dangerously unstable the moment enough of them do. This is not merely an abstract textbook description. It played out in vivid, modern form during the March 2023 collapse of Silicon Valley Bank, when customers, spooked by the bank's disclosure of a significant loss on its bond portfolio, withdrew $42 billion in a single day, and had requested withdrawals topping $100 billion by the time regulators stepped in, a classic bank run compressed into little more than 48 hours by the speed of digital banking apps and viral social media warnings, forcing California regulators to seize the bank and hand it over to the FDIC, which discovered that a staggering 89% of the bank's deposits exceeded the standard $250,000 insurance limit, prompting the Treasury, the Federal Reserve, and the FDIC to jointly invoke an emergency systemic risk exception, guaranteeing that all depositors, insured and uninsured alike, would be made whole, a decision explicitly justified at the time as necessary to protect the broader economy by reinforcing public confidence in the banking system as a whole, precisely the same confidence that Ryan and Olivia's fictional Treasury officials are scrambling to preserve. Ryan, watching all of this unfold, slowly begins to understand just how interconnected the modern financial system has actually become. His mortgage payment cannot process, automatic utility bills fail to clear, online shopping platforms experience payment errors across the board. Retirement contributions simply stop flowing into his account. Even international trade begins slowing as companies around the world find themselves unable to complete cross-border transactions that depend, in one way or another, on the American banking system continuing to function normally, since so much of the global financial architecture ultimately routes through American banks, American clearing systems, and the American dollar itself. By the fifth day, people begin adapting the way people always eventually do under sustained financial stress, neighbors bartering goods directly with one another, local shopkeepers extending informal credit to customers they know and trust, families becoming noticeably more careful with every last dollar of physical cash still in their possession, echoing almost precisely the improvised survival strategies historians have documented from the 1933 crisis, when stores extended credit more liberally for basic household necessities, railroad companies quietly broadened credit terms for stranded travelers, and communities leaned on informal trust networks to bridge the gap left by a financial system that had, for the moment, simply stopped functioning. Financial markets react as well, stock prices swinging with real volatility as investors weigh the risk of a prolonged disruption, businesses postponing major capital investments until payment systems are fully restored, and foreign markets watching developments in the United States closely, precisely because the American banking system sits at the center of so much of global finance that a serious, sustained disruption anywhere within it inevitably radiates outward across borders. Economists studying moments like this consistently emphasize that even a temporary shutdown can meaningfully slow broader economic activity, if the underlying uncertainty persists long enough for businesses and consumers to fundamentally change their short-term behavior, since economic activity depends as much on people's expectations about the future as it does on the actual current state of the system. Finally, on the seventh day, officials announced that banks will reopen the following morning, payment systems gradually come back online, ATMs resume normal functioning, and employers begin processing the payroll that had been delayed all week. First reopening morning, but this time not because deposits have vanished, rather because people simply want the tangible reassurance of seeing their money, of confirming with their own eyes that the number on the screen still reflects something real and accessible. Ryan withdraws a modest amount of cash himself that morning, more for peace of mind than out of any real practical necessity. A small human gesture that mirrors exactly what happened across the country in March of 1933, when depositors who had spent the crisis hoarding whatever currency they could get their hands on lined up in the opposite direction once trust was restored, eager to return that same cash to the safety of a reopened bank vault. Olivia notices her regular customers slowly drifting back into her clothing store, businesses across Atlanta restarting shipments and resuming payroll, financial markets gradually stabilizing as the acute uncertainty lifts, and within a matter of weeks, daily life largely snaps back to something resembling normal, much the way the American economy did within roughly a month of both the 1933 bank holiday and the more contained 2023 regional banking crisis. But the experience leaves a lasting mark on how people like Ryan and Olivia think about money going forward. They come away understanding, in a far more visceral way than they ever had before, that a bank account is not simply a private container where personal savings happen to be stored. It is one node embedded within a vast, tightly interconnected financial network linking workers, employers, suppliers, retailers, investors, and governments together. And when that network pauses, even for a handful of days, the resulting disruption reaches into nearly every corner of ordinary economic life, from a construction crew's paycheck to a small retailer's inventory order to a family's ability to buy groceries without first standing in a long, anxious line. In the end, the 7-day shutdown does not destroy the broader economy any more than the actual bank holiday of 1933 or the actual regional bank failures of 2023 permanently derailed the American financial system. But it exposes something that had been quietly true all along, and that most people rarely stop to consider: that modern economies do not run on cash alone, and increasingly do not run on cash at all, given that fewer than 1 in 7 American consumer payments today involve physical currency in any form. They run overwhelmingly on trust, the largely unspoken and rarely examined belief that banks will open again tomorrow, that electronic payments will clear as expected, that paychecks will land on schedule, and that savings accumulated over years of careful work will remain genuinely available whenever they are actually needed. Without that underlying confidence, even the most technically sound and well-capitalized financial system can face extraordinary strain in a remarkably short amount of time. And perhaps the single most valuable lesson embedded in an episode like this, whether it plays out as a work of fiction imagined for a Monday morning in Atlanta or as the very real crises the country has actually weathered in 1933 and again in 2023, is that the quiet, everyday stability most Americans take completely for granted is not a permanent, self-sustaining feature of the economy at all, but one of its most fragile and most valuable assets, actively maintained through a combination of regulatory design, institutional credibility, and the accumulated, hard-won trust of millions of ordinary depositors who have, so far, always found a reason to believe their money would still be there when they came looking for it again. It is worth pausing on exactly how the modern safety net underneath Ryan and Olivia's accounts actually came to exist, because it was born directly out of the very crisis this story keeps echoing. The Emergency Banking Act, passed by Congress in a matter of hours on March 9, 1933, 3 days into the national bank holiday, gave the Federal Reserve emergency authority to issue additional currency to solvent banks, without requiring that currency be backed by gold. And it set the stage for the broader Banking Act of 1933, better known as Glass-Steagall, which created the Federal Deposit Insurance Corporation as a response to the exact kind of catastrophic, contagious bank run that had just brought the entire national system to its knees. That original FDIC coverage started modestly, guaranteeing deposits only up to $5,000 per account, but the underlying principle it established has proven durable for nearly a century, since that a government-backed guarantee standing behind ordinary deposits is one of the most effective tools available for preventing exactly the kind of self-reinforcing panic that turned a liquidity problem at a handful of banks in 1933 into a nationwide catastrophe. Today, that coverage stands at $250,000 per depositor, per insured bank, per ownership category, a threshold that comfortably protects the overwhelming majority of individual retail accounts belonging to families like Ryan and Olivia's. Even though, as the Silicon Valley Bank episode revealed in stark detail, it can prove considerably less reassuring for businesses and wealthy individuals holding balances well above that limit, which is precisely why regulators felt compelled to invoke an emergency systemic risk exception in 2023 rather than simply letting the standard insurance cap apply. The speed at which a modern bank run can unfold represents one of the most significant differences between the crisis of 1933 and any hypothetical crisis today. In the Depression era, a bank run meant literal lines of anxious depositors physically queuing outside a branch, a process that unfolded over days and gave regulators at least some window to intervene before the damage became irreversible. The Silicon Valley Bank collapse, by contrast, unfolded almost entirely through smartphone apps and group chats among venture capitalists, with $42 billion leaving the bank in a single business day. a scale and speed of withdrawal that would have been physically impossible in an earlier banking era simply because no branch teller network could process that volume of in-person transactions that quickly, meaning the digital convenience that makes modern banking so seamless during ordinary times, is the very same infrastructure that can accelerate a panic to a pace regulators have never had to manage before. This dynamic matters enormously for a scenario like the one facing Ryan and Olivia, because a modern nationwide banking disruption would not unfold through the same slow, visible buildup that gripped the country in the weeks before Roosevelt's inauguration. It would more likely arrive with the same jarring suddenness that characterized Silicon Valley Bank's collapse, compressed from a slow-motion crisis into one that plays out within hours rather than weeks, testing whether today's regulatory tools, communication strategies, and deposit insurance framework can move fast enough to reassure a population that expects instant answers on the same devices that could just as easily fuel the panic in the first place. There is also a structural fragility specific to the modern, overwhelmingly cashless economy that adds a layer of vulnerability the 1933 crisis never had to contend with. When nearly 9 in 10 point-of-sale transactions in the country flow through a card, an app, or some other digital payment rail rather than physical currency, the entire system becomes dependent on a relatively small number of payment processors, card networks, and banking infrastructure providers all continuing to function simultaneously, meaning a disruption at any single critical node, whether caused by a cyber attack, a software failure, or a coordinated banking shutdown like the one imagined in this story, has the potential to freeze commerce far more completely and far more quickly than would have been possible in an economy where a meaningful share of transactions could still fall back on cash sitting in a mattress or a wallet. Federal Reserve Survey data shows that even now, a small but consistent share of the population, including a meaningful portion of unbanked and underbanked households, continues relying on physical cash specifically because it offers a form of resilience that a purely digital balance cannot, a hedge against exactly the kind of systemic interruption this story imagines. And financial regulators in some other countries have gone so far as to legally mandate a minimum level of cash acceptance specifically to preserve that resilience for the portion of the population and the portion of any crisis scenario where digital rails simply are not available. Ryan and Olivia's story, then, is not merely a thought experiment about an implausible emergency alert interrupting an ordinary Monday. It is a distilled version of a tension that runs through the entire history of American banking, between the tremendous efficiency and convenience that a highly interconnected, largely digital financial system provides under normal conditions, and the concentrated fragility that same interconnection introduces the moment something goes seriously wrong. Tension regulators have spent nearly a century trying to manage through deposit insurance, emergency lending authority, and carefully rehearsed crisis communication, tools that have so far proven equal to every serious test the system has faced, from the depths of the Great Depression to the compressed, digitally accelerated panic of 2023, but tools whose ultimate effectiveness will always depend, in the final analysis, on whether the public still believes in them at the exact moment belief matters most. There's a psychological dimension to all of this that deserves its own attention because bank runs, whether the sprawling national panic of 1933 or the compressed digital stampede that took down Silicon Valley Bank in a single business day, are not fundamentally caused by banks running out of underlying value. They are caused by a shift in collective expectation. The moment enough depositors begin to suspect that other depositors are about to withdraw their money, creating a powerful incentive to withdraw first, regardless of whether the underlying institution is actually in trouble. Economists sometimes describe this as a self-fulfilling prophecy problem baked directly into the structure of fractional reserve banking itself, since a bank that is perfectly solvent, holding assets more than sufficient to cover every dollar depositors have placed with it, can still fail if a large enough share of those depositors simultaneously demand their money back faster than the bank can convert its longer-term loans and investments into cash. Meaning the difference between a stable bank and a failed one can sometimes come down not to the underlying financial health of the institution at all, but simply to whether depositors believed everyone else was about to panic. This is precisely why deposit insurance functions less as a mechanism that pays out claims after failure and more as a psychological circuit breaker designed to prevent the panic from ever gaining momentum in the first place. Since a depositor who knows with certainty that the government guarantees their funds up to a generous threshold has far less reason to rush to the front of a withdrawal line the moment rumors start circulating, which is exactly the dynamic regulators were racing to preserve when they moved so quickly to guarantee all deposits, insured and uninsured alike, in the tense weekend hours between the failure of Silicon Valley Bank on a Friday and the reopening of its successor institution the following Monday morning. There is also a contagion risk specific to a highly interconnected banking system that becomes especially relevant in any scenario involving multiple institutions or nationwide disruption, rather than a single isolated bank failure. since fear rarely stays contained to the institution that actually triggered it. Within days of Silicon Valley Bank's collapse in March 2023, a second regional lender, Signature Bank in New York, was seized by regulators as well, driven by a wave of withdrawals from depositors who, having just watched one bank fail, understandably began questioning whether other similarly structured banks might share the same underlying vulnerabilities, a pattern regulators explicitly worried could spread further across the regional banking sector if left unaddressed, which is part of why the emergency guarantee extended to depositors at both failed banks was framed so explicitly around protecting the stability of the broader financial system rather than simply resolving two isolated institutional failures. Ryan and Olivia's fictional 7-day shutdown represents an extreme, deliberately dramatized version of exactly this contagion dynamic, imagining what happens when the disruption is not confined to one or two banks that depositors might reasonably distinguish from healthier competitors, but extends uniformly across the entire national banking system at once. Removing any safe harbor, a worried depositor might otherwise flee toward enforcing the entire population to simultaneously confront the same uncomfortable question, whether the institutions holding their money still deserve their trust. History suggests the answer, so far, has always eventually come back to yes, not because every bank involved in every crisis was flawless, several genuinely were not, but because the combination of deposit insurance, emergency lending facilities, and clear, credible communication from trusted officials has repeatedly proven capable of rebuilding that trust quickly enough to prevent a temporary liquidity problem from metastasizing into a permanent collapse of the system itself. Whether that same combination of tools would prove equally effective against a disruption as total and as sudden as the one imagined in this story, one affecting every bank simultaneously rather than a handful of vulnerable outliers, remains an open question that no regulator has ever actually had to answer in practice. Precisely because a shutdown of that scale and totality has never actually occurred in the modern, digitally interconnected financial system, Ryan and Olivia depend on every single day without ever fully realizing it.